Next up, I'm excited to introduce Christine Benz, Director of Personal Finance for Morningstar. Christine's going to be discussing retirement blind spots, those hidden risks that we often don't think about, but we should. Welcome, Christine. Before I pass the mic to you, I just want to remind our viewers that you're going to take their questions at the end of your presentation. So be sure to type those in on the right-hand side of the screen. We will get to them at the end of the presentation. Take it away, Christine.
Thanks, Lindsay, and thanks so much to all of you for taking time out of your... My focus at Morningstar is the topic of portfolio planning and retirement planning, and we do have lots of great resources on Morningstar.com to help you navigate your way through your retirement plans. I know that many investors have been pretty spooked by what we've had going on in the market recently. We've had extreme volatility, and it's not a bad time to check in on your plan, even though you generally don't want to make any big changes mid-course. If retirement is drawing close, I do think it's a decent time to look at how you're doing and see if any course corrections are in order. So the focus of today's presentation will be some blind spots or risk factors that retirees and pre-retirees and even people who are well away from retirement should have on their dashboards as they think about their retirement plans. So I'll talk about retirement date risk, what that is. I'll talk about sequence of return risk, which is generally what we're encountering right now, the prospect of encountering a weak market environment right at the outset of your retirement. I'll talk about another risk that we're dealing with front and center these days, especially as yields are seemingly as low as they can go, the prospect of very low income that's available organically from investments today. I'll talk about inflation. It seems incredibly benign today, but I do think it's something that people who are retired in particular should be thinking about as a potential risk factor for their investments. Healthcare and long-term care risks are also things that are important for people to think about as they are building their retirement plans, thinking about retirement decumulation, factoring in the role of those additional costs later in life. And finally, I'll talk about longevity risk, which in a lot of ways is a happy news story in that we have more and more people living longer, but that does create hurdles for the retirement portfolio in that the portfolio needs to last that much longer. So we'll talk about how to troubleshoot all of these risks. And you can do that at your plan level as well as at the portfolio level. So I'll talk about some strategies that you can think about with respect to your own plan. So let's get right into retirement date risk. And there's a lot going on with this slide, but basically what it depicts is the fact that as pre-retirees, we tend to not be very good guessers about our actual retirement dates. So the bright blue sort of aqua bar is when people anticipated that they might retire, and the green bar is when people were actually retiring. And so what we can see is that oftentimes people had an expectation that they'd be able to work longer than they actually did. So I would call your attention to that 65 to 69-year-old band. About 42% of people pre-retirement thought that that's when they would retire. In reality, many people were not able to work that long. And there are a lot of things that can get in the way of working longer. Unexpected job loss, ageism is a thing in the workplace. People may have difficulty replacing that high-paying job that they once had. Jobs may be physically demanding, and if someone has a health condition, that may make it difficult for them to continue to do that job. Health issues, disabling health issues, either your own health issues, your spouse's, or your parents' health issues, all of those things can get in the way of someone being able to work as long as they intended to. So that's why we often say, even though working longer is a worthy aspiration, it shouldn't be your whole retirement plan. And the reason it shouldn't be is because prematurely needing to draw upon your portfolio portfolio can create problems for the whole of your plan. So you may not be able to make additional portfolio contributions. You probably won't be able to if you're no longer earning a salary. You'll have fewer years for your portfolio assets to grow and compound. And another key consideration is that a lot of the research we have about what's a sustainable withdrawal amount in retirement has been stress tested over a 25 or 30-year period. If your retirement time horizon is longer than that, you'd need to be more conservative than some of those rules of thumb that you may have heard about, like the 4% guideline. And finally, another important negative component of not being able to work as long as you may have intended to is that you may not be able to delay retirement, delay Social Security as long as you had planned. And when we look at the things that are most impactful in terms of making a person's retirement portfolio last, being able to delay Social Security and enlarge that eventual benefit is one of the key things that you can do to make your plan work together. So how do you mitigate this risk if you end up needing to retire earlier than you expected to? Well, a couple of commonsensical things. One would be to simply continue to nurture your human capital. And that doesn't mean go back to med school or law school or have some big outlay that you may not be able to recoup in your lifetime. But that does mean continuing to invest in additional training, staying current on technology developments, and also thinking about what would be your backup work plan in case you needed to retire earlier. So thinking through your potential encore career. I've often joked to my husband that mine might be a cheesemonger at Whole Foods because I really enjoy cheese, but thinking through what your work plan might be. It might not be as remunerative as the salary that you were able to earn during your full career, but the idea of continuing to defer drawdown of your portfolio can be incredibly impactful. Naturally, if you may need to retire prematurely, that also argues for saving more while you're working. And it also argues for thinking through insurance planning. The biggie, of course, is healthcare costs prior to Medicare age at age 65, what you would do if you had some disruption in your employer-provided healthcare. Thinking through all of those insurance-related variables with respect to premature retirement. This next slide pertains to something that I said is really top of mind for me today. And this is what retirement researchers call sequence of return risk. And there's a lot going on this slide again, but I'll just describe what we're looking at. On the left-hand side of the slide is assuming someone retired in the early 70s with a $500,000 portfolio, a 50% stock, 50% bond portfolio, using a 5% withdrawal rate on that portfolio. Well, what you can see is because that person walked dead into a terrible market environment where we had bad stock returns in the early 70s, we had inflation spike in the 70s and early 80s, that person had what retirement researchers call a bad sequence of returns. So over their particular time horizon, they were out of money in 20 years. Given that the retirement time horizon for many of us will be longer than 10 years, 20 years, that's a retirement fail. On the right-hand side of the screen is just an assumption of what if we reversed that historical sequence of returns. So what if the really great returns that occurred in the early 90s and late 80s actually occurred at the front end of that person's time horizon? Well, the interesting thing is that even though the person had the same 50% stock, 50% bond portfolio, the same $500,000 initially, the same 5% withdrawal rate, the person not only managed to take out their 5% year in and year out, they also managed to grow their portfolio really nicely over their retirement time horizon. So the tricky part of this is that it's really just luck of the draw for all of us. We might have a little bit of wiggle room with our retirement date. So if it seems like things are really gloomy when we intended to retire, we may have an opportunity to delay retirement. But most of us don't have that much wiggle room. So I mentioned why this can be so negative, but I'll just amplify why having a negative return sequence can really matter to your retirement plan. And the key reason is if you haven't taken steps to adequately de-risk your portfolio to add more money to safe investments that you could draw on rather than tapping your equity assets as they're declining, if the stock market encounters a weak environment, the only choice you'll have is to draw down from your reduced equity balance. That leaves less in place to recover when the market eventually does. So this can be really impactful. And I do think it's something that people who are, say, within a couple of years of retirement or even 5 years of retirement should have top of mind for them today. So this is just a quick snapshot of a statistic called Shiller P. It's a cyclically adjusted PE measure. What you can see at the very far right is that this measure has actually come down a little bit. It was very high earlier this year, but generally speaking, we're above average in terms of market valuations. And so that has some prognosticators saying that, you know what, equity market returns over the next decade may not be that great. So this is just a quick screenshot of what our team at Morningstar Investment Management is anticipating in terms of equity market returns. This was as of the end of 2019, so it doesn't factor in the most recent market volatility. My guess is that their projections would be a little bit more sanguine to account for the fact that we have seen valuations come in a little bit. But overall, this is a fairly sober picture when we think about the plain vanilla assets that most of us bring into retirement. So U.S. stock return projections of under 2%, U.S. aggregate bond projections, a little better than that actually, and cash investments right in line with bonds. So if you're thinking about the raw materials for great investment returns over the next 10 years, our team at Morningstar is not especially sanguine, which is not to say over longer time horizons, they don't think that returns will return to a more normal level. But over the near term, this suggests that near retirees should check their expectations accordingly. Looking at some external experts, so not relying exclusively on our Morningstar team, you can see an array of opinions on this slide. Generally speaking, the projections are also fairly sober, although some of them are better and some are worse than what our Morningstar team is expecting. But in general, I'm not seeing a lot of very high numbers on this screen. And that, I think, is another piece of supporting evidence that if you're thinking about the next 5 to 10 years of your retirement plan, it pays to think about maybe having not such great returns. So how do we mitigate this? If the time that we want to retire happens to coincide with a weak market environment? Well, I mentioned one of them, which is that you'd want to maintain enough in safe assets to carry you through if that weak market environment coincides with your own particular time horizon. And then another key thing you can think about, although you may not want to, is the idea of being somewhat flexible in terms of your portfolio withdrawals. So one thing that all of the great retirement research that's been done about portfolio withdrawals suggests is that if people are willing to be flexible about their portfolio withdrawal rates in retirement and take less in weak market environments and potentially take more when the market is up, that goes a long way toward helping their portfolios last during the retirement time horizon that might encompass one of these weak market environments. So that's something to think about. If you can be flexible, if you can potentially rein in your expenses, if a weak market environment coincides with the early years of your time horizon, that can be super helpful. Another thing to keep in mind, though, is if you've been retired for many years already, so if you've been retired for 10 or 15 years, well, the good news is you've really made it from the standpoint of circumventing sequence of return risk. You had fairly decent returns over your retirement time horizon. Yes, you had some volatility. Yes, you had a big bear market, but generally speaking, you've made it through the tough part of sequencing risk. If you're just about to embark on retirement or you've started to retire, sequencing risk should be top of mind for you. In terms of thinking about how to structure a portfolio to prevent sequencing risk or ensure that your portfolio isn't overly subject to it, this is a bucket approach. And this is something that I talk a lot about in my work on Morningstar.com. The basic idea is that I'm using my planned portfolio withdrawals to structure how I hold my assets. So for the first couple of years worth of portfolio withdrawals, well, I don't want to take any risks with those near-term cash flow needs. So I'm holding a couple of years worth of portfolio withdrawals in cash. I'm not monkeying around. I'm just holding FDIC insured investments. And then with money that I might expect to use for the next 3 to 8 or 3 to 10 years of my retirement, I would think about holding that in safer assets, but they don't need to be FDIC insured because I'm a little bit worried about inflation risk once the time horizon moves out. I'd want to think about having a portfolio that encompasses high quality short and intermediate term bond assets. I'd also want to think about having some explicit inflation protection, so maybe Treasury inflation protected securities or I bonds. And because we're talking about maybe another 8 years worth of portfolio withdrawals, I might also add a dash of equity exposure. For money that I don't expect to need for another 10 years, well, that's a safe place to put stocks because stocks over rolling 10-year periods in market history have actually been incredibly reliable. So as long as you have a 10-year window until drawdown, you've been pretty safe holding stocks. So I'm holding stocks in bucket 3. This is kind of a globally diversified equity portfolio. And the idea is if Armageddon materializes for my portfolio, I wouldn't need to disrupt any of my equity assets. It's kind of a nice hedge against sequencing of return risk. So if this volatility that we've been experiencing sticks around for a while, and I think it's anyone's guess as to whether it will, the idea is that you've built yourself a runway of 10 years worth of cash flows to ensure that you're not having to sell any stocks when they're in a trough. So this is just a sample bucket portfolio. I've created lots of different permutations of these bucket portfolios on Morningstar.com, but you can see it's structured in the way that we've just talked about. So we're assuming a $60,000 year one portfolio withdrawal. So that's not taking into account any other non-portfolio of sources of income that someone will be bringing into retirement. So most of us will have Social Security, for example. So here we're assuming a $60,000 spend down in year one of retirement. We've held two times that amount in cash, 2 times that $60,000. Bucket 2, we're just stepping out on the risk spectrum into that high quality short and intermediate term bond portfolio. And bucket 3, that's the growth engine of the portfolio that holds the bulk of this particular $1.5 million portfolio, and that is in a globally diversified low-cost equity portfolio. Another risk factor that I think is top of mind right now is the fact that even though we have had yields go down, which is good for bond prices, if you're inclined to subsist on whatever income your portfolio kicks off, it hasn't been a great environment, right? So if you wanted to keep the money safe in very safe investments, you've had to make do on lower and lower yields. So this matters because a lot of retirees, especially if they're traditional minded, think about not touching their principal. They want to try to subsist on whatever income distributions their portfolios kick off. So when yields decline, retirees are stuck with a really unattractive choice between subsisting on less, which few of us want to do in retirement, or venturing into higher yielding, higher risk bonds. So this is a risk factor that is definitely top of mind for new retirees. And another thing to think about is, as we've seen yields decline, bond yields have historically been a pretty good predictor of what the bond market will return over the next decade. So I need to update this slide, but the current long-term Treasury yield is very, very low. And so that portends weak returns from the bond market over the next decade. So just a quick cautionary slide about the risk factors of venturing into some of the higher yielding, higher risk bond types. You can see that, yes, yields are better than you can earn on a Treasury portfolio or on a Bloomberg Barclays aggregate portfolio, but the risk is definitely there as well. So I've just provided 2008 returns here for a little bit of context. While these bond types definitely held up better than the stock market in 2008, I think the S&P 500 was down like 37% that year. Directionally, they were really quite similar. So just a cautionary note about loading the boat with some of these higher yield bond types. So how do we mitigate that? Well, I think a key thing to think about at the portfolio level is to think about a total return approach as a mitigating force against a low yield environment should it stick around for a good long time. So I think it's just a change in mindset that retirees need to reorient themselves toward. The basic idea being, I'm going to try to grow my portfolio as large as it can be for retirement. And then when retirement comes close or begins, I'm going to prune whatever makes sense from my portfolio and not get so hung up on ensuring that all of my portfolio withdrawals consist exclusively of ordinary income. Pruning appreciated securities makes sense too. In fact, I had been saying for the past few years, as we saw stocks go up and up and up, retirees, even though we've seen yields stay low, your best source of cash flows for the next few years is hiding in plain sight in your appreciated equity portfolio. My hope is that they took me up on that advice because it's a little bit late now, given that we have seen equity valuations come in a bit, but it may not be, depending on your situation. So another approach that you could use with respect to your retirement portfolio and your decumulation plan is to think about kind of a hybrid approach, where maybe you are spending current income. So if you have a portfolio that is kicking off some yield, use that to supply living expenses, but then reach into appreciated portions of your portfolio to trim them back after periods in which they've performed well. So these are just some quick examples of how retirees can use that hybrid approach to source cash flows in an era in which yields aren't so great. So 2017 is an example of a really great year in the equity market. Yields weren't that great. So if you had a plain vanilla 60-40 portfolio, you would have gotten about a 2.1, 2.2% yield from that portfolio. But because the market performed so well, you could turn to appreciated equity assets to supply additional living expenses. Other years won't be that good. 2018 was a recent example where the market did not perform well. Rebalancing proceeds, if you wanted to trim appreciated securities, those opportunities were few and far between because the stock market wasn't great. The bond market was no great shakes either. So that's why if you're thinking about your retirement portfolio plan, I like the idea of using a couple of years worth of portfolio withdrawals to hold that money in cash to tide you through a weak environment like this. Maybe 2020 will be kind of a similar environment when it all shakes out. That's the idea of having that cash buffer built into your portfolio plan. Another risk factor I want to touch on briefly is just inflation. And of course, inflation seems incredibly benign right now. And certainly if you're a working person, you don't need to worry too much about inflation with respect to your retirement plan. The reason is that you are getting your cash flows from your salary. You're probably getting cost of living adjustments through that salary. So inflation isn't top of mind, and it shouldn't be top of mind for you. And another key thing to think about is in terms of your portfolio complexion, if you're still accumulating assets for retirement, you probably have a fair amount of your assets in stocks. So even though stocks haven't been any sort of direct hedge against inflation, so in a year when CPI shoots up, stocks aren't guaranteed to shoot up as well. But stocks over time, over long periods of time, have historically had better returns than other asset classes. So you're protected by having those cost of living adjustments. You're also protected mitigated by having hopefully some ample equity exposure in your portfolio. The people who need to be more concerned about inflation are retirees. And there are a couple of key reasons why. One is that for retirees, medical care, health care expenses are simply a bigger share of what retirees spend money on. So this slide depicts various calculations of the consumer price index. The CPIE, the green bar, depicts expenditures for older adults. So that depicts the consumption basket for older adults. And so what you can see is that medical care has historically been a bigger share of what older adults spend money on. Pretty intuitive finding there. So what we've seen with medical expenses is that even though inflation has come down a little bit post Affordable Care Act, what we've seen is that inflation in healthcare expenses has been running higher than it has for the general inflation rate. So if you're a retiree, I think that makes inflation a bigger concern. So if you're spending more on healthcare and healthcare inflation is running hotter than the general inflation rate, that suggests that you need to think more about inflation with respect to your plan, even if those general CPI statistics are pretty benign currently. So we talked about some of the reasons that it matters, that inflation matters for retirees. One thing I want to call your attention to is if you're retired, getting close to retirement, think about your portfolio and the complexion of its portfolio. Most of us, as we get close to retirement, are steering more assets into safe securities like cash, like bonds, while anything like that with a nominal interest payment to shareholders is going to get eaten alive by inflation because it eats away at the purchasing power from those investments. So as you age and as you steer a higher share of your portfolio into those types of investments, you need to take extra safeguards to protect your portfolio against inflation. So a couple of thoughts about how to mitigate inflation risk. At the portfolio level, I mentioned earlier the value of having dedicated explicit inflation protection in the form of Treasury inflation protected securities, and you can buy mutual funds and exchange traded funds that focus on TIPS. You can also buy I-bonds directly from treasury.gov. Stocks, I mentioned why stocks are so valuable in your accumulation years. They're also valuable in your decumulation years as a way to out-earn the inflation rate. And finally, you might also look to niche categories. A couple of them include bank loans, high-yield bonds, again, minding the risk. REITs have also been shown to be fairly inflation-fighting because these are baskets of companies, baskets of properties that charge rent. And when inflation is running higher, these landlords are able to push through higher rents on their tenants. And finally, at the plan level, delaying Social Security is also incredibly valuable because not only do you earn an enhanced return for delaying past your full retirement age, that enhanced return is also inflation adjusted. Also think about inflation protecting any other products that you're bringing into your plan. So if you're looking at an annuity, for example, ask about whether the payments that you receive are in any way inflation adjusted. I want to just talk briefly about healthcare costs later in life. This is a slide prepared by my colleague David Blanchett. Basically, it is examining the trajectory of the average retiree's spending. And what it shows is that spending trends up early on in retirement, it trends down in sort of the middle part of retirement, and then trends up later in life. And that is to make way for healthcare expenses. So just a quick snapshot of the outlays that the average couple incur in retirement. It's kind of a staggering number. Most of us, if we're contributing or paying for healthcare through our employer-provided plan, don't feel our healthcare expenditures as directly, but in retirement, many of these expenditures are out of pocket. And importantly, Fidelity's estimate of $280,000 that a married couple will need in retirement does not include long-term care. So I just want to skip ahead to how you mitigate that. Well, I think it's important to bear in mind how your healthcare costs could impact your retirement plan. So think about how your retirement outlays may change over your life cycle. So even though your spending may trend down, it may ramp up later in life. Want to just touch briefly on the virtue of health savings accounts, which are the only triple tax advantaged savings vehicle in the whole tax code. So the money going in isn't taxed, the money can grow on a tax-free basis, and assuming that you pull the money out for qualified health care expenditures, the money is tax-free as well. One important note about HSAs, health savings accounts, is that you need to be covered by a high deductible savings plan to contribute to them. But these are really neat ways to save for healthcare expenses in retirement, and you will have healthcare expenses in retirement. Long-term care risk, we could do the whole session on long-term care. Many of you have certainly dealt with long-term care expenses if you've been helping loved ones, if you have parents or grandparents or a spouse or other loved one. You know that these costs can be absolutely disastrous. So unfortunately, there aren't any good ways to mitigate long-term care risk. Purchasing insurance is certainly one avenue. Increasingly, there are these hybrid long-term care annuity or hybrid long-term care life insurance policies that you can buy. Those have become more popular. Those are attractive in that they give you some optionality in that if you don't end up needing long-term care, you have the full annuity benefit. If you don't end up needing long-term care and you have a life insurance hybrid, you have the full life insurance benefit. So those are something to consider. Just a cautionary note on relying on government resources, because there's a lot of confusion about what the government does and does not cover with respect to long-term care costs. Medicaid is the largest provider of long-term care in the U.S., but relying on Medicaid can create risks for the well spouse in that you essentially need to deplete all of your available resources to be eligible for Medicaid-provided long-term care. And you also have many fewer choices in terms of the type of care that you can receive. Just a quick note about longevity. This, in a lot of ways, is the good news story and a lot of the gloom and doom that I've talked about. The basic idea is that many of us are working fewer years and we're retired longer. So there's a lot to love about this slide, but there are challenges from a portfolio standpoint. This slide just depicts a few other statistics on longevity. Men tend to live a few years shorter than women. One thing I often say to groups of investors is that if you are wealthier, chances are you've had access to more and better healthcare during your lifetime. You'd want to think about a longer life expectancy than the averages that you see. So how do we mitigate longevity risk? Well, thinking about it at the portfolio level, that calls for being conservative about your withdrawal rate. It calls for potentially reinvesting required minimum distributions that need to come out of your traditional tax-deferred accounts once you pass age 72. And finally, it calls for maintaining a healthy allocation to stocks throughout your retirement time horizon. So retirees who have too conservative portfolios, I think the big risk factor there is that if retirement is very long for them, their portfolios may not last. Mitigating at the plan level, I've talked a few times about the virtue of delaying Social Security to capture that enhanced benefit. Another category to consider if you're concerned about longevity and its impact on your plan would be annuities. And of course, that's a really broad basket. Some annuities are terrible and high cost, but very simple, low cost, plain vanilla, immediate or deferred annuities can be incredibly impactful in terms of making sure a portfolio lasts and in terms of providing a lifetime stream of income in retirement. So those are my planned remarks. I'm going to leave it there. Lindsay, I'm happy to take any questions that have come up or anything else that occurs to you.
Absolutely. Thank you, Christine. That was a really timely presentation, especially given all the volatility that we're seeing. And if our viewers are getting close to retirement, you're here at the right time on the right day. So let's go ahead and take some questions. Wade asks, what are your thoughts on negative interest rates?
Yeah, good question. And that is a real possibility in the decades ahead, or in the maybe the near term. I think we've just seen this tremendous flight to safety, Lindsay, where investors have said, I need to keep my money safe, and even if it means that the interest rate I need to settle for is non-existent, that's okay with me. And so I do think that investors should get comfortable with the prospect of low or even negative yields. But I also think it's really important to remember the role that bonds serve in portfolios, which is to be that ballast in periods of equity market weakness. And that's one thing that we've seen, even though there's been so much attention to being paid to what's been going on in the equity market, we've seen diversification work really well, where bonds have actually gained a bit even as stocks have slid recently. So I guess I wouldn't, it's hard to say don't get too concerned about negative yields, but remember the main reason that you hold bonds as a portion of your portfolio, and remember that they're the shock absorbers of your portfolio, the piece of your portfolio that can gain a little bit in periods of equity market weakness.
Absolutely. That's a very good point, and I couldn't agree with you more. We talk about diversification all the time, and that's why we offer products here at Ally Invest that have 30% cash cushion in some of our managed robo portfolios. But having that exposure to fixed income or a small portion in cash definitely helps in times like these. We do have another question from Bull Z Fan 72. How do dividend paying stocks fit into the bucket system you shared?
Yeah, good question. And so people love their dividends, and dividends have really looked beautiful through the recent market turbulence. I know a lot of retirees really love to build portfolios that are structured and consist almost entirely of dividend paying stocks. I would still give myself a nice long time horizon to hold dividend paying stocks. So you might spend the dividends and use them to supply a portion of your cash flows on an ongoing basis. But I also think it's really important to build yourself kind of a front end. You might not need as large a bucket as I've included for buckets 1 and 2, but build yourself a bulwark against a 2008 style environment where we saw banks slash their dividends, and the retiree who was relying exclusively on a dividend paying stock portfolio was forced to either sell those depreciated bank stocks or move into something conservative at the wrong time. So I like the idea of holding the dividend paying stocks in the long-term time horizon bucket, in the bucket 3, and building enough of a front end to ensure that you're never needing to sell those stocks in a trough.
Really great advice for our viewers. We got another one. Joe Smith says, regarding HSA accounts with 20 to 30 year time horizon, would you recommend taking advantage of investing those HSA dollars into aggressive equities?
What a great question. And the answer, Lindsay, is absolutely. So sometimes people hear HSA and they think, oh, those things are use it or lose it, right? They get them mixed up with flexible spending accounts, which are indeed use it or lose it in most cases, where you need to empty them out each calendar year. HSAs can be invested in long-term assets, and they should be. If your goal is to tap the money in retirement, get it invested in an aggressive portfolio. You can take maximum advantage of the tax sheltering ability of the HSA. You can take advantage of your nice long runway to retirement. So I think that's a fantastic strategy. Just bear in mind your own spending patterns, though. So if you expect to spend something from your HSA to cover healthcare expenses as you incur them, you can either segregate some safe assets within your HSA to defray those costs as they occur, or ideally you can use non-health savings account assets to cover your healthcare costs as you incur them, and leave the HSA assets undisturbed to take advantage of those great tax benefits and your long time horizon.
Well, I think you kind of answered the question. Joe Smith had a follow-up to his previous question of what ratio would you put into aggressive funds versus conservative funds. I don't know if you had anything additional to add.
Is this with respect to HSAs,
HSA,
Lindsay?
yeah.
Yeah, I can't give anyone any individualized advice. It really depends on your anticipated time horizon until needing those funds. But certainly if you are a high income earner who has the wherewithal to cover healthcare outlays, as you incur them, I think you can afford to have a fairly aggressively positioned portfolio. So you might use, a globally diversified index portfolio. You can get that money mainly invested in stocks, but you just want to make sure that you won't need to invade it in a period of market weakness like right now.
Right, absolutely. Getting a lot more questions here. Jewel for Prez asks, what role do bonds play, given that cash and bond yields are pretty similar today, but bonds have interest rate risk?
That's such a good question, because when you look at what you can earn on online savings accounts, for example, in some cases they're even better than what bond funds are yielding today. I think the key issue to think about is inflation. So with your cash assets, what you see is what you get. Whereas if we do have higher inflation, higher yields coming online down the line, the bond investor can partake of those higher yields. Whereas if you have all of the money in cash, that won't benefit you. So my bias wouldn't be to overdo the cash investments, even though I think they're a valuable part of the retirement plan. I think you would probably want to also hold some bonds, interest rate risk and all.
Very good advice and very good points there. I think we're going to see if there's any more questions coming in. But in the meantime, the bond online savings question is a really good one, especially for us here at Ally, because we do have higher yield savings accounts that our customers absolutely love. But if we are entering a period where inflation is about to take off, you do need to take that into consideration within your investment mix, especially, like you said, if you're getting closer to retirement.
Right.
I think we have one more question that we can go through here. Just give me 1 second. Dave Matthews asks, what is your opinion in converting IRA to Roth to avoid RMD? It's a good question.
It's a really good question and a timely one, because if you are converting traditional IRA balances to Roth, you'll owe taxes typically. And generally speaking, you're better off doing those conversions when your balance is down, because the taxes that you owe will be keyed off the amount in your account at the time you did the conversion. So this is a great place to get some tax advice. Work with a tax advisor or a tax-savvy financial advisor. One strategy to consider is you may be able to do a series of conversions over a period of years. And the virtue of that is that you're not necessarily putting yourself into a higher tax bracket with those conversions. So that can be a really great strategy. The big advantage to it, as the question hinted, is that you won't be required to take required minimum distributions from Roth accounts. In addition, the amount that comes out of Roth accounts is tax-free. So I think it's a really valuable strategy to consider, particularly for folks who think that they'll be in a higher tax bracket in retirement than they are today. That's the profile of the individual for whom a conversion will be most attractive. So the idea is that you are taking the tax hit now in an effort to reduce taxes down the line, or potentially to reduce taxes for your heirs. So definitely a place to get some tax advice, but a strategy to consider, kind of a silver lining in bear markets too. It's one of the rare things that you can do to actually be productive when the market's going down.
Yeah, that's really great insights there. And thank you, Christine, for your time today and your presentation.